The stock market is a weird creature. It's a place where people voluntarily give their money to strangers, hoping to get more back. But here's the thing. In the short run, the stock market is more like a popularity contest than a measure of actual value. It's a voting machine where the majority rules and prices are driven by emotions, trends, and even rumors. As Benjamin Graham, the father of value investing, once said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. This quote from Graham's sets the stage for our exploration of stock market's actual personality. On one hand, we have the short-term market where prices can fluctuate widely based on the sentiments and speculations. It's a world where traders and investors are constantly trying to guess what others will do next, creating a self-reinforcing cycle of fear and greed. But what about the long-term market? Is it really a weighing machine where prices reflect the true value of companies? To answer this question, let's take a step back and look at how the stock market works. At its core, the stock market is a place where people buy and sell prices of companies. These companies have real assets, earnings, and growth prospects, which ultimately determine their value. The problem is that in short run, prices can deviate significantly from this underlying value. This is because markets are driven by human psychology, which is prone to biases and emotions. For example, during the dot-com bubble of the late 90s, investors bid up the prices of tech stocks to the stratospheric levels, despite the fact that many of these companies had no earnings or even a viable business model. But as the years went by, the market began to weigh the true value of these companies. Many of them went bankrupt while others survived but saw their stock prices plummet. This is the weighing machine in the action. The market eventually reflects the true value of companies regardless of what investors think or feel in the short run. So what we can learn from this dual nature of the stock market? For one, it's essential to have a long-term perspective when investing. Instead of trying to time the market or make quick profits, focus on buying high-quality companies with strong fundamentals. Over time, the market will weigh these companies' true value and patient investors will be rewarded. As Graham once said, price is what you pay, value is what you get. In the short run, the stock market may be voting machine, but in the long run, it's a weighing machine that reflects the true value of the companies. By keeping this in mind, investors can navigate the market's ups and downs with confidence and reap the rewards of long-term investing.